Warren Buffett once said, "You don't find out who's been swimming naked until the tide goes out." And in Berkshire Hathaway's second quarter 2025 earnings, the tide went out on more than just the stock market. Berkshire's profits took a hit. A $5 billion mistake was finally admitted, and yet this giant walked away with the kind of financial firepower that could reshape markets if the next crisis hits. Today, we're not just breaking down numbers, we're diving into the most important takeaway from Berkshire's latest results. The surprising resilience hidden behind the headline decline, the lessons from Buffett's rare admission of failure, and the strategic position that could define Berkshire's next era under Greg Abel. Berkshire Hathaway reported Q2 2025 earnings of $12.4 billion, down sharply from the $30.3 billion it posted in the same quarter last year. At first glance, it looks like a stumble. Operating earnings, which Buffett himself calls the most descriptive measure of our performance, dropped by 4%. But here's the twist. If you strip out the insurance underwriting drag and the other segment distorted by foreign currency swings, Berkshire's core operating profits actually grew 13% year over year. That's the kind of detail most headlines skip, but it's crucial for understanding what's really happening under the hood. It tells us this: Berkshire's core engine is still firing, even in a tougher macro environment marked by sticky interest rates, shifting consumer demand, and geopolitical uncertainty. One of the biggest headlines wasn't about new gains, but about an old wound. Berkshire finally took a $5 billion impairment on its investment in Kraft Heinz, a position Buffett has long admitted was a mistake. Years ago, Buffett overpaid for the deal, betting that Kraft Heinz could maintain its dominance in the branded food space. But competition intensified, private labels surged, and changing consumer tastes eroded the value proposition. By writing down the investment, Berkshire essentially admitted this capital could have been deployed better. Buffett has said before, the most important thing to do if you find yourself in a hole is to stop digging. And this write-down is just that, stopping the digging and facing reality. In today's market, where corporate leaders often dodge accountability, Buffett's willingness to own his mistakes is more than refreshing. It's instructive. It shows a discipline that's key to surviving long-term in investing. Insurance is Berkshire's largest earnings engine, and in 2024, it was as good as it gets. This quarter, not so much. Underwriting profits fell from those sky-high levels, though every major insurance unit, GEICO, Berkshire Hathaway, Primary Group, and Reinsurance, still turned a profit. GEICO's combined ratio, a critical measure of insurance profitability, came in at 83.5%, meaning they only spent 83.5 cents for every dollar they took in. That's elite performance in insurance terms. Policies in force grew again, pointing to a return to profitable growth. And then there's the float, the money Berkshire holds from insurance premiums before paying out claims. That float hit $174 billion, up $3 billion from last year. In a world where interest rates remain elevated, that float becomes a cash-generating machine. Every month the Fed keeps rates high, Berkshire earns more on that massive pool of capital. Burlington Northern Santa Fe, Berkshire's massive railroad operation, quietly delivered one of the quarter's biggest wins. Operating earnings surged nearly 19% year over year thanks to improved productivity. Buffett had previously said the railroad isn't earning what it should, but the latest numbers show a turnaround in motion. Manufacturing, service, and retail operations, an eclectic mix that includes everything from auto dealerships to candy shops, posted an 11.9% jump in pre-tax earnings. Berkshire Hathaway Automotive was up 8%, while Nebraska Furniture Mart and See's Candies saw even stronger growth. The takeaway? While big tech and speculative growth stocks have dominated headlines, Berkshire's old economy portfolio is quietly compounding value in sectors that are far less vulnerable to the hype cycle. Here's where things get really interesting. Berkshire is sitting on $339 billion in cash and cash equivalents. That's almost 30% of its total assets. Why so much cash? Buffett has always said he keeps a fortress balance sheet so Berkshire can pounce when markets are in distress. And while interest rates are higher, which means that cash itself is earning more than it has in years, the real strategic value comes from optionality. Buffett put it plainly years ago, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. With this cash pile, Berkshire isn't holding a bucket, it's holding an industrial-sized tanker. In today's macro context, with markets priced for perfection, recession fears not fully gone, and geopolitical risks simmering, that cash could be the single most valuable asset in corporate America. For the fifth straight quarter, Berkshire did not repurchase any of its own shares. That's a deliberate choice. Buffett's rule is clear. He'll only buy back Berkshire stock when it's trading below his estimate of intrinsic value. Earlier this year, Berkshire's price-to-book ratio climbed to nearly 1.8, far above the levels where Buffett typically buys aggressively. But here's the subtle signal investors should watch. After a recent pullback, valuations are edging closer to levels where buybacks could resume. That matters because buybacks have been one of Buffett's most effective capital allocation moves in recent years, boosting per-share earnings growth well above the growth in total earnings. If buybacks return, it'll be because Buffett, or Greg Abel, sees genuine value in Berkshire's own shares relative to everything else they could buy. This quarter's report comes with a shadow hanging over it: Buffett's announcement that he will step down as CEO at the end of 2025. Greg Abel, currently vice chairman for non-insurance operations, will take over as CEO, with Buffett staying on as chairman. The leadership change is massive in symbolic terms. Buffett is more than just Berkshire's CEO, he's its culture, its philosophy, its compass. But Abel is no stranger to capital allocation. He has been deeply involved in Berkshire's deal-making and operations for years. What will investors be watching? Whether Abel maintains Buffett's discipline on capital allocation, resisting the urge to chase trendy deals, while also seizing opportunities that may emerge in a volatile macro backdrop. Perhaps the most telling part of this quarter's report isn't in the earnings table at all. It's in what Berkshire did and didn't buy. For the 11th consecutive quarter, Berkshire was a net seller of stocks, unloading $6.9 billion worthwhile, buying just $3.9 billion. This isn't just portfolio tinkering, it's a statement. Buffett and Abel are saying, we don't see compelling value at current market prices. That's critical context for investors who are looking at today's stock market, where the S&P 500 is still riding high despite mixed earnings and macro uncertainty. Berkshire is playing defense, waiting for the market to offer them the kind of fat pitch they can swing at hard. Berkshire Hathaway's Q2 2025 earnings send a clear message. This is a company in transition, not because it's weakening, but because it's preparing. The $5 billion Kraft Heinz write-down is a reminder that even the best investors make mistakes, and that admitting them quickly is part of winning long-term. The insurance and railroad operations show the power of operational discipline, and the $339 billion cash hoard, that's a loaded spring, ready to snap into action when markets falter. Buffett's legacy is about patience, discipline, and the courage to act big when the world is panicking. Greg Abel's challenge will be to carry that torch forward in a market where the next big opportunity could come without warning. As Buffett once put it, we simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. Right now, Berkshire is patient, and for investors who understand the game, that patience is the most bullish signal of all.